Welcome to the show. Glad to have Sean Campbell back. Good friend of the pod. I think this is your third appearance, so excited to have you back. Also joining us is Tim, and let's go around quick backgrounds. Sean, why don't you start us off? Keep it brief, but let's hear about your background, and we'll also include links from your previous episodes as well.
Excellent. Well, thanks, Mike. Thanks, Skylar. Good to see you both again. Yeah, I'm getting to be like the Andy Richter on the Conan show. I'm a regular guest now. So again, Sean Campbell, Managing Director of Valiant Finance. And Valiant Finance, just think of us as a small alternative investment shop that what we're trying to do is put out products that are innovative, effective, but most importantly, simple and effective for our clients in the income arena on a Reg D basis, private placement basis. So with that, my background prior to this was traditional capital markets, mostly fixed income, really specialized in Ginnie Maes prior to coming over and helping manage a Bitcoin mining fund, which is what we'll talk about again today, kind of where we are now, if you will.
Cool. Thank you, Sean. Tim, let's kick it your way.
Sure. Thanks for having me. So Tim Bartlett. So my kind of background is started a career a little down the road down here in Florida. Worked at Raymond James in equity research, kind of learned the ins and outs of equities, portfolio management from there on the equity side. And then from there, I actually moved over to BlackRock, where, I learned everything, learn equities, learn fixed income, learn derivatives, learn how to manage portfolios, how to manage risk, and, manage with some of the best and biggest institutions in the world. So took that experience and then said, hey, I think I'm ready to go from kind of the institutional portfolio management process and managing that way and bringing it to the retail clients. And that's when I jumped and went to kind of the retail side, working with advisors, where I am now. And, now I'm down here in RIA managing $750 million as a senior portfolio manager on all the strategies, on the portfolios, and, looking to deliver, the best investments for our clients.
Yeah, cool. Yeah, thank you, Tim. So I guess to start off the conversation, Sean, let's get the latest. We had you on probably about the same time last year, I believe, when you guys were launching this Bitcoin mining fund. Give us a quick recap of the fund, and then let's talk about where you're at today.
Yeah, absolutely. So yeah, I guess like we talked about before, I'd rather be lucky than good. And we got lucky as we filed about a year and a half prior and then launched just to happenstancely around 2 days prior to Bitcoin ETF actually launching. So with that, as the ETF comes out, as we all know, the minute an ETF is out, all of a sudden we've got a traditional asset class. So it was nice to see that we were able to kind of get out there at the same time. It was not by design. It just took us that long to register and get everything through, as you can imagine. When you hear the word Bitcoin, immediately everyone says, okay, volatile, risky, I'm not sure about this. So, what we saw in the marketplace at the time, the reason why we did this was we understood that digital mining was really a cash flow industry, but there was a massive problem, at least in our eyes, in the traditional capital marketplace. There's this vacuum that exists now where clients are going to need income to supplement their retirement. I mean, when you think about the second largest generation our country's ever seen in the baby boomers that are going into and going through retirement right now, this is no longer their grandparents' traditional investment environment. They can't go buy a AAA bond and just sit on it as fixed income anymore. So we saw this vacuum and started to put the dots together and said, exactly what Valiant's terms are is we look for these innovative ideas that can generate some sort of steady, predictable cash flow that'll help folks like Tim and RIAs out there build out income models. And that's essentially what we did with this mining fund. So just the quick recap on it is we have two different notes, if you will. The first note is very simple. It's a 48-month note. That's by design. If you think about it, there's a method to our madness. So we all know that the cycle of Bitcoin, no matter how volatile Bitcoin is, it's equally as cyclical, and it lasts from halving to halving 4 years. So that's the reason why it's 48 months. And it's a 15% distribution to our clients on an annual basis, paid out monthly. We thought the monthly component was effective, given the fact that a lot of folks are going to use this for retirement and to be able to supplement income. And then what we noticed when we went to market with this was some folks said, this is great, but folks that really understood Bitcoin and really were bullish on Bitcoin, if you will, said, well, wait a minute, Sean, what happens when Bitcoin goes to 100,000? And my answer to that was, well, what do you mean? Well, I'm obviously making more returns than just 15%. That's paltry, Sean. Well, no, we designed this to be a steady, predictable cash flow for your client so you can build an income model around that. And then the next question that I received from them was, well, that's not fair. And I said, oh, fair. So fair means you want to take the risk alongside of us. Okay, we can do that. And that's where note number 2 came from, which is the participating note. And again, we're simple folks at Valiant. We like to keep it simple. So we made it simple. We said, okay, again, 48 months, we'll pay it out monthly as well. The only difference between note 2 is those returns on a monthly basis will be variable. The client will receive 50% of the net cash flows that we bring in on a monthly basis from the digital mining operation. And as we all know, as much as Bitcoin's volatile, hash price does move as well. So that'll be variable as well. So when Bitcoin's doing really well, obviously the returns are going to be much higher than that 15%. When Bitcoin is where it is right now, as we can talk about it, hash prices and just about touching 50, obviously, those returns are not as robust as our folks that are in the 15%. No.
You got the challenges with the risk, right? You got to make that decision one way or the other, which is a, I think it's a good opportunity one way or the other to have that option, as you mentioned, for you listen to your clients and you gave them another option, which I think is great.
Sean, tell us about some of the challenges that you guys have been, what are some of the challenges that you've noticed with the mining space, with your time in the industry so far?
Yeah, great question. As I won't belabor the point, but for the folks that haven't seen any of the other podcasts before, the reason why this man Bigfoot sits behind me is, as we've talked before, it's always about the unseen risk. So to your point, Mike, it's great to come up with a model and to be able to build this vision and engineer a fund and say, okay, this all looks good, but we all know that's just a model. So now what happens when you go to practicality? So to your point, what are the challenges once you start running this business? Can you actually deliver on what you said? And thankfully, because of my risk mitigation mind and always being Debbie Downer and thinking about the worst possible scenarios, when we last spoke, we talked about the model and we talked about, well, where's that kind of break-even point, Sean? Obviously it's not guaranteed. You're fairly certain you can hit that 15% on note 1, and it's based on the math. It's just a math equation, just like bond math is. But the practicality of it is, does it work? And I'm happy to say, not that I'm happy where hash rates are, since most of us in the Bitcoin world talked about historical lows and that historical support level being around the $60 hash price. As we know now, as we fast forwarded through halving, my gosh, we've been challenged. The hash price has gotten as low as 38 and high change, 39. Nobody ever thought it would be there. It's dipped below 60 before, but to put it in perspective for folks that don't follow this on a regular basis, we have dropped about 33% below that historical low that we used to engineer this model prior. Here's the cool thing about that. Is the model is no longer just a theoretical model. It's been tested, it's been taxed, and it's actually worked. So, for the past 6 months or so, I think we're on their 6th distribution or so, our folks that are in note number 1, 15% returns, they don't care where the hash price is. They get their returns every single month like clockwork. We've not missed a distribution. We're not in jeopardy of missing a distribution, which has showed us that as much as we built this model for what we call Bitcoin winter and the 60 lows, we've now been taxed and we know where the model stands before you kind of have that area where you're like, okay, we're in trouble now. And we've talked about this in the past one is, there's no secret sauce to mining since it's a math equation. The biggest thing you have to worry about as a miner is what's your cost of power and what's your overall cost. And as the two of you know, when we talked before, that was by design. We wanted to make this a streamlined operation and keep the expenses as low as possible because all we're trying to do is throw off US dollar cash flow to our clients. We don't need a big $30 million facility to house all of our miners and make it look nice and pretty. We need to be able to keep our expenses low for these reasons. When you're in this part of the cycle and it does throw a curveball at you and you're lower than you thought you would be, my gosh, you just wipe your brow and you say, wow, the model's still working and it's actually working well to the point where it's doing better than we thought on the downside. So we're optimistic about that. We still want hash prices to go up, obviously, but we're very optimistic that now that we're in the reality of it, it's actually working, and we're in the downside of it and it's working. We're really looking forward to when hash prices start to spike here in this parabolic phase of the Bitcoin mining side of things and Bitcoin price appreciation as well, that it's going to get fun for our folks that are in Note 2 and our folks that are in Note 1. Hey, we're doing exactly what we said we were going to do for you.
All right, that's great. And obviously, setting the foundation of what you mentioned early on, obviously is paying dividends in real time, which is pretty amazing. I mean, the space in general, do you see it from a mining perspective, other competitors in the space? What does that look like? Obviously, you weathered the tide, and it's been fantastic. And how have you set up everything up? But for your perspective, where's the space in general perspective?
Yeah. Good question, Skylar. So it's there. That's a double-edged sword. It is fun to be a pioneer, and it is absolutely maddening at times. So, and Tim knows this because I was a hound on Tim for the better part of 3.5, 4 months as we walked through this story to get him comfortable with the math side of things. But to this day, as far as I know, only my opinion, and I do research this on a regular basis, we are the only game in town. And what I mean by the only game of town is if somebody wants to be invested in the Bitcoin mining space, if you will, as a client, as an end user, prior to us coming on board, really the only option you had was to go out and purchase one of the public stocks, whether it was Marathon or CleanSpark or BlockRiot, any of the big kind of block or the Bitcoin mining companies that were public, you can get exposure to Bitcoin mining that way. There was no one out there that gave exposure quite the way we did. And to our knowledge, there still is no one out there. So we were able to take this idea and commoditize it into a cash flow stream. And Skylar, like I said, it's great to be king of the hill and the only one there. But at times it's frustrating because when you talk to advisors and end user clients, everyone wants to be able to compare. That's what we do as people. We want to say, okay, this is a competition. Are you the best in the game? Well, when I look behind me, there's nobody else there. So it's hard to gauge that now. That being said, I'm sure that people are going to catch on to our model and start getting out there. But as it stands to this day, we're the only game in town to be able to use Bitcoin mining as a cash flow vehicle for clients.
Yeah, that's definitely interesting. Well, that's probably a good segue from Tim's perspective as conversations are being handled by you, Tim, and your client base. The questions that they're asking you, and obviously to Sean's point, the story and kind of the message that you're explaining to them about what this opportunity is. And I'm just curious kind of how you're allocating to clients and what are the questions that they're asking you in real time today?
Yeah, good question. No, yeah. So, taking a little step back here, I kind of first had this conversation with Sean, almost probably 15 months ago. We sat down in Chipotle and he's like, oh yeah, I got this great idea. And I'm like, all right, well, what do we got? And he's like, Bitcoin mining. I'm like, yeah, I don't know much about it. I know Bitcoin pretty well. I know there's mining, but you can't make, how are we going to turn that into an investment product? You go, oh, just wait. It's coming. Fast forward, many months through, a lot of calls, a lot of texts, a lot of communication, the structured note, the private placements came out. And I said, all right, this is pretty interesting. So walk me through that. And, it took me a few times, maybe 5 times to get through it all and understand the math. And then it's looking at, well, okay, let me look at the hash price. Okay. Well, that's interesting. I can see the chart and, everyone can see that the last 5 or 6 years. I'm like, yeah, I see what he's saying. It does kind of follow cycle and then it goes up to 100, 200, 300, 400 at times. And then it comes down. I'm like, well, that's interesting. And it's like, okay, well, what do you think? What's your break even cost? Where's your probability levels? And then he's like, they're really low, watch this. And then he actually showed me the model, kind of to bring it to life. And it's like, wow, you guys got something here. This is very interesting because when I look at this for a potential investor for our clients, it's okay. Understanding returns sound really good. You're saying 15% on one, no one, and then potentially more. You got my attention when you said, mid-teens returns. I'm like, all right, I don't see a lot of that. Equities historically averaged close to 10 or 11%. So you're saying you give me above that with a different risk. There is risk, but there's different risks. I'm like, all right, let me keep going on this because this is really fascinating. And you're telling me you give me monthly cash flows. That gets my eyes wide because clients are looking for cash flows, and they're looking for alternative investments or looking for uncorrelated assets. And they're looking for good returns, positive returns. And when I pieced this together, it was, all right, I think I'll look at it as clients know, one, think of it as a bond, right? It's a different bond, but the beauty of this bond is you're not taking interest rate risk, which in 2022, everyone took interest rate risk. We're down 10, 15, or 30%. If you bought a 30-year U.S. Treasury, supposed to be one of the safest bonds out there. Well, you forgot about the interest rate risk. So you eliminate that. Now you still have obviously credit risk, but it's really mining operation and profitability of mining operations. And they're running a very, very low cost structure, which gives you a lot of flexibility on that. So, when you look at the risk reward, I thought no one was great for clients where a portion of their assets were saying, hey, let's maybe move some fixed income, maybe some cash, and make it a one step out, go from the right hand and go to left hand and go, hey, we're getting maybe 5% on your bonds over here. Let's take some and get 15. Let's triple that with different risks. And I would argue probably less risk, but that's up to the investor. And then for some clients, it's, hey, note two, if we think this is really going to happen, we're really going to see those average hash price, which are really average hash price, Sean has mentioned, is around 150, 160 over a cycle over 4 years. If we'll get anywhere near that, let's try to make note two and make more. And think of that as equity risk, right? You could make a lot more than 15%, but you could make less. And there's a possibility you lose money, but it's not going to be correlated to equities, right? It's going to be some correlation to Bitcoin price, but hey, if the equity markets are down 30%, doesn't mean this is not going to work. So I think adding, the right note for the client and having those conversations is where it's made sense and it's worked really well. And, I just had to go through the education process with clients, and I thought it was going to be one meeting. It turned out there's just so much information. It ended up being 2 meetings or 4 meetings, depending on the client. And that's okay, because it's just a lot to take when you go from, hey, we're talking about Bitcoin. Now we're talking about Bitcoin mining operations. And then we're talking about the operations within a structured note private placement. So there's just a lot of layers you kind of walk through clients. But overall, they've been very happy. They really like the differentiated asset, and, the returns, and the clients in No One have been clipping coupons and been very happy. So very successful so far.
I love it. And Sean, why don't we just do a quick aside? Tell us about Bitcoin hash price. Just tell us, kind of what this means, and give us like how it changes over time.
Yeah, absolutely. Why don't I step back for 1 second and just give a little idea of what I always do from a historical perspective to give an advisor or a client that doesn't know a darn thing about Bitcoin mining. What is it? And the way that I've always explained it is, I was a history major many moons ago. So if you think back to the late 1800s, when we had this craze called the gold rush out in California, 300,000 people went out there, but did all 300,000 strike the mother lode? Of course not. There was a very small percentage of them. And the way that I like to explain the mining side of things is, there was a contingent of folks during the gold rush period that made a very steady, predictable income. And those folks were the ones that were selling the picks, the axes, and shovels to the said 49ers to go strike it rich. So I always use that to compare, to give everyone an idea, because the minute you say Bitcoin, it doesn't matter the second word mining. Everyone hears Bitcoin and just thinks volatile, volatile, volatile. So with that, what allured me to the mining side of things, to your point, Mike, is it's just simply math. It's a math equation. And being a bond guy for as long as I was, that's what attracted me to the fixed income world, was the bond math. It was very simple for me to understand. The simplicity of bonds is, I can build a portfolio and protect a portfolio and know the outcome of the portfolio based on where interest rates are and based on where my duration and credit risk is. The interesting thing for me is, when I pulled everything together on the mining side of things, as we know on the bond side, this first equation here, the interest rates, we don't control that. The Fed does. So as a fixed income professional, you really become a weatherman. Get it right. And if you get it wrong, what happens to that output? That output changes, and not in a good direction. With Bitcoin mining, the way that I like to explain it is, think of it as bond math. But there's a beauty to Bitcoin mining, because instead of that interest rate risk that Tim alluded to, your risk is what you're paying in power. As you can imagine, these mining operations, the one that we've got in Denver City and Dimmitt that are in the fund right now, are running about 13 megawatts of power. that can power 1 to 2 small towns. That's how much power we're using. So the power bill gets quite high. When you're high on the power bill and hash price is a little bit lower, what is the outcome there? As a mining operation, you need to keep your expenses as low as possible to withstand those lower hash prices. So to your point, Mike, we have our power purchase agreements in Texas are at 4 cents a kilowatt hour, which is one of the industry lowest in the country. To put that in perspective for people that don't understand power is if Sean Campbell right now were to go buy an ASIC machine, which is a miner, and plug it in behind Bigfoot here in Lakeland, Florida, where I live, I would pay 22.5 cents a kilowatt hour to run that. I would not be very profitable, especially where hash rates are now. So from a mining perspective, the price of Bitcoin doesn't necessarily matter to us. The Bible for every miner is hash price, to your point. And what hash price is an amalgamation of 3 different things. It factors in the price of Bitcoin, of course. So when you're in those bull runs, and to Trump that was in the Bitcoin Nashville convention saying Bitcoin to the moon, when it gets to the moon, obviously hash prices are going to be at the moon as well. But there's 2 other components that actually factor into how a miner gets paid. One is what's called the difficulty level of the source code. So as we talk, not to get too granular, but as we know, the algorithm of Bitcoin is every 10 minutes, that math equation will be solved, which now newly mints a little over 3 Bitcoin every 10 minutes, 7 days a week, 365 days a year, 24 hours a day. So with that, what essentially happens is the difficulty level is factored into how many miners are actually trying to solve this math equation. And it's very simple. The more miners that are trying to solve this math equation, the harder that equation gets, because we've got to keep it at that as close to that 10-minute cadence as we can. But what happens when hash price is low, as you can imagine, if I'm paying a lot in electricity, that's not a zero-sum game anymore. That means that I'm paying more in power than I am for what I'm being awarded. So a lot of miners will unplug at that time because it's not profitable for them. When that happens, the difficulty level comes back down again. And the third part, which didn't really factor in all that much up until Bitcoin ETF really went live, is what's called the transaction cost. So if you think of the blockchain, the way that my simple brain works is, I hate all of the big terms that we use in any industry. And it's the same in cryptocurrency as well. I think of a blockchain as a big Excel spreadsheet. It's essentially monitoring every single Bitcoin wallet out there. And there has to be a bank teller, if you will, that makes a transaction. So when Skylar wants to send Mike all of his Bitcoin after we get off the phone here, who's going to record that transaction? It's going to be us. It's going to be the miners. We go into that blockchain and validate and say, yes, Skylar has Bitcoin. We're going to move that into Mike's Bitcoin wallet and move forward. As you can imagine, there's a fee that comes along with that. The reason I said that it didn't really factor in until Bitcoin ETF is because if you thought prior to the ETF going live, transaction costs for us as miners represented about 1% of our total profit or revenue on a monthly basis. Since Bitcoin ETF came into the equation, as you can imagine, transactions have gone through the roof. It's now equating to 16 to 17% and continues to climb for all miners as far as the profit or the revenue that we receive on a monthly basis. That's a great thing. And the reason it's a great thing is because we're not going to be as reliant on the Bitcoin award as we move forward as we have been in the past. So it kind of smooths out a little bit, if you think about it in theory, the hash price, because that transaction cost gets baked into the hash price as well. So the theory is on cycle basis, you should start to see a little bit more of a smoothing and not as volatile moving forward. As you guys know, for us being the Debbie Downer fixed income guy we had to engineer this for the rainy day, for the worst section. So, I don't care where we are at the top. Everybody's happy when you're at the top. It's where you are at the bottom. And are you able to deliver for the client? We've been able to do that.
Yeah. Thank you for going into that. I guess from Tim, on your side of things, is this, what's the client feedback? Like, is this, are you typically having like multiple calls with these folks, to kind of explain this aspect of it?
Yeah. So, once we kind of get everything running, the documents signed, client sign up, there's that 3-month blackout period. So, that's where, I get some calls and emails and texts going, hey, I haven't got my first check. And it's, yeah, well, remember that, conversation I said a few times, they gotta get all the equipment, get all hooked up. And then after the 3 months, we get the first check. So it's been, positive feedback. It's just a lot of clients going, "Hey, I'm ready for that income. I'm ready for this to work. Where are we at?" And thankfully, we have clients already getting those monthly distributions, and they're like, "This is great. This is working. This is what I like." I mean, spoke to a client a couple of days ago, and she's like, "Yeah, I got the first check, and yep, it's exactly what you talked about for note one, and we're great. We're depositing this, and this is part of our income, and I'm very happy." And so it's been really good, and we got more coming down the pipeline. They're going to do that, but so far it's been very good, and it's more just keeping up the education and keeping them aware of what it is. I had one client who proactively now, a couple clients will reach out and be like, "Hey, I see this mining operation. This firm is investing 200 million, and this firm is Riot. They're announcing $1 billion expansion. Man, I'm really glad we got in this investment. Seems like this is where all the money's going and capital's flowing, and it seems like this is a spot on profitable investment. I'm really excited for how this looks 4 years from now, over the next 4 years." So it's been very good. I'm hopeful. I imagine maybe 6 months or 12 months as clients see this check come in every month, especially on note one, and then we have a run in note two. I imagine they're going, "Hey, why don't we do more? How do I do more?" I'm sure that's going to come. It's just clients want to go, "Hey, I like the first check. I like the first 2 or 3. Once I see 5 or 6 or more, then it's go, why don't we move maybe a little bit more over here? And this side of the portfolio is only giving me like 4 or 5, and this is 15. What are we doing here?" And that's probably coming down the line, and we probably will do more. But I'll also say, hey, as much as I like Sean and the notes and making money, we got to be aware of liquidity risk, and we got to be aware of concentration risk. So it'll come down to the normal principles that we talked about. I've learned from BlackRock and been dispelling to our clients for 20 years. But we did take a smaller allocation for a lot of clients, so we can ramp that up. It's just will give us some time, see the proof in the pudding, make sure the models and Valiant and Sean, everything's exactly what we hoped. And so far, it's been better than expected because hash price has been lower than expected, and it's still been able to make out those, especially no coupons, and that's huge. Don't miss the coupons, keep paying, and clients are happy. And then I'm not getting yelled at, and I like that.
Oh, that's great. I find it fascinating too, just kind of what you explained to him, and John gave obviously the background of how this works. On the conversation with clients, obviously, in a traditional sense, we're all from industry, right? How do you talk about how this fits into a portfolio? What's the allocation look like? But the conversation changes based on education and what we're talking about here. So, and obviously, as you mentioned, now clients are coming to you and say, hey, they're looking at the industry, mining, giving you examples because now they're being educated as to how this works. When you start those conversations, is it strictly, hey, this is how it fits into a portfolio, or are you having to take a lot of time to really explain process, Bitcoin mining, obviously what Sean explained here, which is great, right? I was just curious kind of how those conversations started and how they progress over time, because it is interesting how, as we come from finance, that conversation changes and the story changes, how we have to explain and educate the client base on this new asset class, and specifically mining in this case.
Yeah, no, I mean, great question. So I think first step is I know our clients, first thing is, hey, they're accredited investor, first thing, right, to meet the requirements, and really they're above that. But I always start with education. So the first thing I kind of do is I do like a quick summary email that I've kind of perfected on kind of the key points as I've kind of gotten through many clients on what they're looking for. Get it there, and then we set up a call, we'll have a conversation. I don't talk about allocation or potential investment until really the very end or the second call, because I want them to get comfortable with the what we're doing, the process, and mainly the structure, right? Liquidity is key. Hey, if you invest $100,000, you can't, come to me 6 months or a year ago, hey, I know this is like a great investment. I know it's going to work out. I need the 100,000 out because, we're buying another vacation house in Europe and I need the money. Well, remember, this is a 4-year no, there is no liquidity there. It's non-traded. So we can't get that principal back. If you're no one, you're getting that monthly cash flow. So you are getting return, you're getting money, but I can't go and call Sean, hey, Sean, hey, Joe Smith, sell that, sell those miners, get them offline. It's just not going to happen. So it's about education, liquidity, the risks. And then we just kind of talk through Yeah, here's just a general framework of how hash price is, mining operations. Here's just some general numbers on, as long as everything over the 4-year cycles is above, these numbers, you won't have a problem. And then I want to sit back and listen to the client. What did you hear? How do you feel about this? We don't have to do this investment. This is a part of your investments, a small portion. What do you feel? And then if they're good with it, we move forward. I kind of the next call, I like to try to do a second call. And then from there, it's, hey, I'm going to identify what I think is where we can fund this, right? It's going to be in an after-tax account, a non-qualified account. And then we're going to go, hey, I like to always say 5% or less of your net worth. And usually I even, start a little bit less than that, maybe 2.5. Go from there. And then some clients will say, hey, I'll do a little less. Some clients will say, hey, this is really good. I want to do maybe 3 or 4 or 5 because this is great. So kind of start the conversation, get the client involved, educate them, and make sure they're aware of the risk. Because most thing is I want to make sure everyone's clear on the risk, liquidity, in what we're doing, because this is different and unique. And then let's talk about the positives being uncorrelated assets, mid-teens return, monthly cash flows, get people all excited after that, but let's be aware of the risk. I always like to lead with risk and liquidity first. That way no one's not aware of all the details, and repeat that a lot of times because, what we say a lot, and it's not what I say, it's what they hear. So let's make sure they get the key points. We can't get out of liquidity on that.
No, that's great. And like you said, for kind of what you're going after, credit qualified investors for income is the outcome, right, that they want, right? So that is definitely what the focus is. And that's amazing. That's very cool.
Yeah.
I would say one other thing is, I kind of switched on income, and, now with, Goldman Sachs and several others come out with, hey, the next decade is going to be 3% for S&P or global equities or even less. Some of these I've even positioned as total return, right? Because, hey, 15% is no joke. That's solid. That's great returns. And if you don't need the income, that's fine. Well, you can come back in cash, and then we can reinvest that income, whether it's cash or, equities. But I think it's really both, especially in note 1 and note 2, really is more total return. But it's just when you're potentially looking forward and as a portfolio manager and really as an advisor, you got to say, how am I going to meet my clients' objectives? How am I going to lead their total returns? And if we are going into a, decade of very low returns, which is a very good possibility we are, you kind of need to look at alternative investments that get you better returns. And this is exactly what Valiant and Sean have, and why, more advisors should be looking at this, because this is going to help solve outcomes and improve their clients' overall portfolios and retirement.
Yeah. Tim, this is great. Let's talk about a little bit about like the due diligence process, because you work with a lot of different, alternative investments. What does that aspect kind of look for you, or, look like on your side, and, kind of how do you tie it into the Bitcoin mining side of things?
Yeah, good question. Yeah, it's rigorous, let's say the least. Coming from BlackRock and then Raymond James, it's do your homework, read a lot, don't trust a lot, and keep going. So I think it was really about probably 6 to 9 months of once I talked to Sean, kind of getting some information on that. I mean, I had him send me the PPM, which is 160 pages, and guess what? I'm that crazy portfolio manager and analyst where I read every page and I went through every page. I reviewed that. And then after that point, it's a lot of calls with Sean. I mean, I did calls with Catherine from Valiant, who was great, who was part of the operations. We even, I did a call with, Kevin, who helped runs Deep Hash as well, to get familiar with him, because he's a big part of the team. So it's going through the key players of the operations, because it's not just Sean, but Catherine was a big part of it, as well as Kevin. Understanding that, having conversation with them, drilling them on all the what ifs, the bad scenarios. Hey, what if Bitcoin gets banned in the U.S.? We can't mine anymore. Where are you going to go? And Kevin and Sean are like, yeah, we got that covered. Yep, we're in containers. Maybe we'll move to El Salvador, right? Okay, all right, fair enough. So it's just going through all the process of what could go wrong, understanding, but it's a lengthy process, because I don't take investments lightly for our clients, as fiduciaries. And when I've been doing this a long time, want to get it right for clients, want to make sure it's, a great risk reward and an investment that I would be comfortable with myself, or be comfortable putting my parents in if it made sense. So treat it with the utmost, care, respect, So it takes time. And to Sean's point, I was like, hey, do you got any competitors I can look at? Like, what am I supposed to compare this to? And he's like, sorry, I don't got nothing. Then I kind of went down the rabbit hole. Well, let's understand the public miners, the Rias, the Marathons, because you can see what they're forecasting, see how they treat the mining operations, see their profitability levels, and get good knowledge from there. And then I went to a kind of several outside opinion. Some of their firms, there's a lot of Bitcoin mining newsletters and opinions. Take that in because there's pros and there's cons. You got to see both sides of it. You want to try to be as neutral, independent as possible. But when I, did it all together, I said, hey, based on all the factors, there is some risk. Obviously, the returns are really good. Risk return is one of the best investments I've seen, in my career, right? And I think this has got to be something where you got to allocate for, certain clients or high net worth clients where it makes sense because, 15% monthly basis or more is very, very good returns with, I think, very measurable risk. And that's the key. Measurable risk is why it makes sense.
I want to pivot this slightly to talk about, obviously you're a big macro guy, Tim. How do you see Bitcoin from the macro side of things?
Yeah. So Bitcoin, I think it's a good call. Macro, where we go from here, the economy, I think we're going obviously slower growth from here and what happens. One thing I love about Bitcoin is, right, it's demand and supply equation, right? You got a fixed supply at 21 million, demand is only going to be increasing with the SPY ETFs. And then you have institutional ownership, you have pension funds, are investing now, you have corporations investing, MicroStrategy, you probably saw MicroStrategy, probably the biggest investor. They're going to try to do maybe another 40 billion offer just to buy Bitcoin. Now you have more companies doing that. So when you look at, kind of macro, I think, the economy will sludge around whoever is present and wherever we go. But when you look at, I come from economics, right? Price equals demand and supply. Well, you got a fixed supply and, mining, every halving supply comes less and less, right? Less supply is coming on board. Demand keeps going up. Naturally, you got to have, price go higher. So I think wherever kind of the macro environment globally goes, that's the beauty of it is that Bitcoin can be that differentiated asset, uncorrelated asset, and it can defy where equities go. Normally, yes, Bitcoin price will follow risk assets, equities, but, for a certain period of time, some of that correlations is breaking off. But if you continue to see the greater demand coming in, it's not going to matter. Bitcoin price is probably going to continue to go higher. So I think it's going to be an interesting environment. And I think it's going to be really exciting to see what happens over the next 4 years, because I do think we're going into a slower economy. We might even go to a soft recession. We might be in a recession now. But, Bitcoin right now is the number one asset class, up close to 65%. So we'll see where we go from here.
Yeah, no, that's great insight. I guess going back to you, Sean, from Tim's perspective, how you see it, I'm curious, the future state from zooming out from your lens, looking 4 years and 8 years ahead. What does that look like for you?
Yeah, I put my math hat on, Skylar, and it's funny, if you think about all of the opponents to Bitcoin prior to the ETFs, all the major, wirehouses out there and major investment banks out there that were, just poo-pooing Bitcoin and saying this is not good. And then all of a sudden ETF comes out and everybody's like, oh yes. And now we've got an entire team that follows the research, right, and we project out and you start seeing some of these numbers of some of these big investment banks that have said beforehand that they didn't like Bitcoin, but now they've got research analysts that are saying, oh, by the end of the year, it's at 100,000 or beyond. And, I smile at that because all they're really doing is what every one of us is doing. We know that Bitcoin is, one, a cycle, and two, it's math. So when you think about the prior halvings and where we've been with Bitcoin, and as you get into that next bull market, to Tim's point, supply and demand. Supply got cut in half, newly minted, the supply cut in half. Demand didn't change. Actually, we would argue demand's gone up now. What happens when we're at the gas pumps? When Saudi Arabia decides to cut 2 million barrels of oil? Well, gosh, I'm paying more than $4 a gallon. How does this happen? Supply and demand. So when you look at the past halvings, for instance, the last halving that we had 4 years ago, Bitcoin went up by 7.7 times. all we're really doing is projecting out and saying, again, put my bond hat on and say, well, let's just say it goes up half of that. We don't have to average that all the time. Even if we go up 50% from where that is, where does that put us at Bitcoin within the next 6 to 12 months? That number's somewhere around 120, 125,000. I've heard most of the consensus around there. I would tend to agree with that. Again, I'm Debbie Downer. Maybe I go a little bit lower than that. But I had folks, I talked to a fairly well-known Bitcoin mathematician that believes in the law of power, the power laws, that is trying to convince me by the year 2050 that no doubt about it, Bitcoin will be at $1 million a coin. And I'm like, my goodness, my head just spins thinking about that. And there's been other investment houses, well known, that we all know the names, that have said, oh, absolutely, in the next 2 years, $1 million or bust. Again, if you just take the average conservative approach based on the law of economy, there's really no reason why this asset shouldn't be at over 100,000 in a short period of time. My humble opinion, in the next 6 to 9 months or so, we should be in that 125, somewhere in that range, and then we continue to build from there.
That's awesome. Yeah, definitely interesting times for everybody. Where everything's going right now.
If I could step back to one quick thing that I wanted to make sure I made a point on, because I heard Tim talking about educate. To your point before, Skylar, that's the big thing for me, is we have to educate not only advisors, but the end users, the client as well. And as long as we are getting them comfortable with what this is and giving them the information they need to make the decision whether this fits, then we're doing our job. I mean, it's been a fun ride. To Mike, you had asked beforehand, like, the where are you now, from when we talked about this as we were just getting ready to launch it, and we had all these great big designs. Well, guess what? We're now 6, 7 months in. So, where have you got? There's been some fun times, and to the education part, I run a webinar every Wednesday at 2 East. So if anybody ever wants to know and at least get an idea of the granularity of why is Bitcoin mining different than Bitcoin, you can catch me on LinkedIn at any time. But it's been interesting coming from nothing, where no one knew us, to now within the last 6 months, we were on the cover of Financial Services Review, and we won Specialty Finance Company of the Year. So that was exciting. It wasn't all that fun seeing my ugly mug on the front cover, but at least Kevin and Catherine are on that front cover as well, which kind of brightens it up a little bit. But it's been fun from those peaks, if you will, but there's also those challenges. There's been challenge. We're running a business, and you have things go down. You have a step down transformer go down. What do? That's why, to Tim's point, when you have a good, well-rounded team like that, and you've got Catherine running the fund and the operation side of things, but then you've got the technical side of Kevin. When a step down transformer goes, my head would explode. It's just, what are we supposed to do? Kevin's got it covered. So it's been a fun ride so far. We're really looking forward. I mean, every weekly meeting we have, we're talking about new opportunities that are coming across, institutionally speaking, large opportunities where some of these larger institutions are like, Sean, we like what you're doing. We want to put 150 million to work. Can we do this as a separate? Absolutely. The case is there. The capacity constraints that we will have will only rely on where we can get the power cheap. And the good news for the community right now is we've got a good list of targets that we can deploy and get to, because we've been doing this since 2017. So we have those contacts to get those PPAs, or those power purchase agreements, in place. Where it's going to get confusing and a little bit scarce is when this really catches on and that list starts to deteriorate. That's where your capacity problems come into play. We will not go out and buy a property and pay more in power just to build this fund out. We've got strict parameters. If we can't get that at 4 cents a kilowatt hour, then just by faith, we don't want to do this, because our first commitment is to our clients. And when we engineered this product, it was, we need to build from the ground up. If we start changing this equation here and ratcheting it up, thinking, well, we just need a little bit more return, or the hash price has got to be a little bit higher and we'll still do it. It doesn't work that way.
It's actually,
that's where
it's an interesting point, Sean. In terms of that, what are you guys looking at in scale? What do you see as kind of your upper limit?
Yeah, great question, Mike. So as it stands today, both of these notes are offered at 50 million. We've raised, we're approaching 10 million or so now. So you would think in theory, okay, you've got some capacity room there. The honest opinion of that is we're starting to see this snowball now. It started slow, as you can imagine, education. And now that people are catching on, it's like we're getting more and more phone calls like, okay, I've got $1 million I'm deploying next week. So as that goes, we're going to move these notes, if you will, up to 100 million and then essentially 150 million. But to your point, Mike, if I looked at our ability, if we had all the capital in the world right now, we could have this built out at over 300 megawatts, which would be about a $300 million AUM at that point. It's, the rough industry average is every $1 million you're deploying is basically energizing a megawatt of energy for Bitcoin mining. So I would say we're at, conservatively about 300 million now before I'm calling investors and saying, hey, if you want it anymore, you might want to get in now because we're going to be running scarce, and then obviously closing and then reopening when we do find the right opportunities.
Yeah, I love it. What do you guys have in store for the future? Where do you see this going over the next couple of years?
Yeah, very good question. So the good news is if you follow me on LinkedIn, if you don't, please do, because if you follow me on LinkedIn, you'll see everything about our mining endeavors out there. So last post I put out last week was one of the containers arriving in Dimmitt, Texas. If you don't know where Dimmitt, Texas is, don't worry. Most people don't know where Dimmitt, Texas is unless you live there. But it's in the North Panhandle of Texas. And essentially that facility there is, we had purchased and we can run 8 megawatts. We are down to the last container before that one will be filled. Then we'll be moving back over to where our first facility for the fund was, which is Denver City, Texas, and building out another 15 megawatts or so there of capacity. But, if this moves in the way that we think and are optimistically thinking, essentially, I would love to say that within the next 12 to 24 months, we're sitting at 250, 300 megawatts worth of mining capacity and running. And that's just on the retail side of things. When we talk institutionally, like I said before, with some of these $150 million deals that we're talking about, that'll be a separate facility. We run that as a separate account, if you will. I mean, think about that. If you've got an investor that wants to place 150 million, we want to make sure that we're running one facility for them. And we've got properties identified at 150 megawatts that we can actually do that.
Very cool. Very exciting. A lot of interesting things happening and a lot of plans. I think it's very cool to see kind of where you guys started and kind of where things are happening. Always paying attention to risk, mitigation mindset there as well.
Yeah. Any final thoughts on your end, Tim? Anything you want to let the audience know about or thoughts you have, whether it's this investment or anything?
Yeah. I mean, I guess selfishly for myself and my clients, I hope, Sean doesn't get to 250 million too fast so I can get more clients in and have a great advantage over all the other advisors in the area. So in the state, but no, I think it's a great opportunity, great investment. I think it's one of the most unique investments I've ever seen out there. Across the board. And I think as advisors and clients move forward, there's going to be a bigger push for alternatives. And this fits the bucket, there's, whether it's, Franklin Templeton or Goldman Sachs or JP Morgan, if you look at any of those, great strategies and their outlook, it's, hey, the 60-40 portfolio is probably dead. You need to reposition and add, 10, 15, in most cases. Most firms are saying you need to add close to 25% alternatives. Well, you got to start filling that bucket. I've been kind of ahead of the game for a couple of years for our clients in private markets, whether it's private credit, private equity, private real estate, some hedge funds, and now it's looking at other alternative, total return or income solutions like Note 1, and then as well as Note 2, with Sean. So you got to look there. You got to be aware of that because we're probably going into an environment with low returns and. You better be ready to deliver better returns, and this is exactly the type of investment that can do that. So, highly suggest advisors to be open-minded and get in investors and say, "Hey, take a look. Do your education. Have a call with Sean. Think it through. It's not always might not be right for everyone, but it definitely can fit for a lot of clients, and they can benefit, and that would be a good thing."
Yeah. That's great. That's a really big thought. The 25% alternatives. I like where your head's at, and kind of where this market's going is going to be really interesting the next couple of years.
Actually, if it's up to me, I'd probably go more, but I got to be respectful to traditional markets, but it's probably going to go higher because if you look at on the whether it's a endowment fund or pension funds, and some of the biggest pension funds in the world, you can look at it, whether it's Yale or Harvard. You know how much public equities they have? A lot of them less than 10%. It's over 90% is alternatives. So there's in family offices close to 35 to 40% alternatives. So if you look at the biggest and the best investors who have the best returns with mitigated risk, they have higher allocation out to alternatives. Retail clients have got to be more aware, but there's definitely a argument to say it should even be higher. It's just going to take some time to get there and everyone comfortable. But great products like Sean, alternatives like this option can be one of the pieces to the puzzle.
I love it. Well, that's a great spot to wrap, guys. Tim and Sean, really appreciate you guys joining us again. Thank you guys for the time today, sharing your insights. Start with Sean. Sean, where can people go to connect with you and learn more about Valiant?
Absolutely. You can catch us on either valiantfinance.net, which is our website. We also have the mining website, which is dpash.net. Catch me on LinkedIn. Like I said, that's probably the easiest because I'll post once a week or so. Like I said, there's a webinar going on every Wednesday at 2. I post the invite to that on LinkedIn as well. I catch you all there. Mike, Skylar, so good to see you both again, man. Thanks for having me on again. I appreciate
Absolutely.
it.
Yeah, so much, Sean. And Tim, on your end, where would you like to send people? And is there any type of person that might be best to reach out to you?
Yeah. So I mean, first off, thanks for having me on the podcast. I think to Sean's point, Sean's probably the best contact to reach out to on that. Kind of go from there. He'll kind of take the education from there. I'm always my name Tim Bartlett. You can find me on LinkedIn if investors or clients want to reach out, and we can kind of have a conversation from there. But the resources that Sean has, he's the expert, he's the man, but I'll also help facilitate and have conversations as well with clients or investors that make sense.
Yeah, that's awesome. We appreciate it both, guys, and we'll make sure to include information in the show notes, and also that your weekly webinar, Sean will put that there in there as well.
Thank you,
of course.
Awesome. Thanks so much, guys.